I'm going to lead us through this discussion. Everyone should have a PowerPoint handout. I will mark it up there October 24th. And we just wanted to talk about the economy, the markets, where we stand today. It has certainly been a really dismal third quarter of the calendar for the markets. And we're scheduled to review the performance of the PERS, the DB and the DC plans at our December meeting, but figured we didn't want to wait that long before we're talking about what's happening within the market. So page one is just a snapshot of the U.S. economy. The two charts above are, we don't have, the U.S. GDP number has not been released yet for the third quarter. So the chart on the top left is through June. Shows you what it's looking like historically. I can tell you, so it was 1.3% for the second quarter. And the good news is that the consensus estimate for third quarter GDP growth is 2.5%. So that, you wouldn't know it, right, by listening to the media and reading the newspaper. So that hopefully will maybe calm the markets a bit. And then the right chart is showing the inflation numbers, the CPI and the core CPI, which strips out food and energy. Now that data goes through August. But that number through September actually has been released. And the CPI was 3.9% for the last year through September. And the core CPI was 2%. Now, 3.9 sounds a little bit high, but commodity prices have been easing lately. So we figure that's going to continue to come down as we move on here in the next couple of months, which should provide some support for real, in real dollar terms and reduce any fears of inflation. Now, we have another bullet point here: unemployment. So nothing's changed, right, with the job situation, unfortunately, in this country. At the end of September, the unemployment rate was 9.1%. So it's been around 9 for quite some time, and we don't really see it moving much off that number, unfortunately. Lastly, the Fed in October initiated what they call Operation Twist, where they're going to sell $400 billion in short-term treasuries. They're going to buy $400 billion in long-term treasuries through June of next year. And the goal is to bring down long-term interest rates, hoping to that will spur some refinancing in the mortgage market and bring down the mortgage rates. And also, it would just make other asset classes frankly more attractive than bonds. So the riskier asset classes like equities, so trying to help the equity market there.
Are these new issues or are these current issues that are on the market?
They are.
So
It's already on their balance sheet.
sorry.
Right. So kind of taking a step back though, what happened in the third quarter, right? I mean, we'll see in a minute here that equity markets were down around 20% for just the 3 months ended September 30th. Now, large cap U.S. stocks were down about 14%, so not as much. But small cap and international, both developed and emerging, all down about 20% in the third quarter. So what happened? I think there are a couple factors at work. One, there was during the quarter an increased recognition of the decelerating global economy, right? So everyone, the data came out, people are realizing, okay, this economy is slowing, both in the developed world and in the emerging world. And that was negative for the markets. Two, we've got this European sovereign debt crisis, which won't go away. And the European leaders are having their 12th meeting, I think, right now, and they're supposed to announce a new agreement today. Greece is now expected to default. The market is expecting that. And Europe is trying to figure out a way to contain, not only Greece, but Italy, Spain, Portugal, all those countries have major debt problems. And really, now it's an issue between France and Germany. They're arguing over who's going to be responsible and what the framework's going to look like. European banks are undercapitalized. It's a big problem. During the financial crisis of 2008, the U.S. did a really nice job of capitalizing its banking system, increasing Tier 1 capital ratios. In Europe, they didn't move as much there, and so their banks are more vulnerable. And then another factor is we had in the quarter was the U.S. debt ceiling debate, compromise, and the S&P downgrade, right? So that put a focus on our own debt problems, which spooked the markets during the quarter. So all that kind of contributed to a pretty ugly third quarter. Now we are seeing, monetary policy starting to ease with Operation Twist. The European Central Bank has increased their liquidity for their banks over there, and but fiscal policy. So we're seeing monetary policy ease a little bit, but people are constrained in terms of fiscal policy. We're going to see fiscal policy be contract in the U.S., probably in most developed countries going forward for the foreseeable future. So that we're not going to have that in the quiver, so to speak, to try to fix the economy. Okay. You turn to the next page. I thought this was really kind of wraps up the feeling of why this recovery that we're in. Right, we have been growing the economy in the U.S. For over a year now, actually longer than that. Back in 2009, when the recession officially ended, yet it certainly does not feel like a recovery. And what this chart is showing are two primary statistics. One is the unemployment rate, and this goes back to January of 2000. So that's the black line, and the gray bars indicates a recession. So we had the recession back in early 2001 after the terrorist attacks, and then, of course, the most recent Great Recession, so to speak. And then the red line is the median household income index, so people's real income, and how that's grown or detracted over time. And that's okay. So you see what's interesting. So if you look at the recession of 2001, the unemployment rate increased, to be expected, but the income levels actually went a little bit higher during that recession. And then you look at the most recent recession, the unemployment rate really skyrockets, goes from 5% to over 9%, while the incomes decreased just a little bit, not by a lot, but they decreased, nonetheless. And then you see what's happened post recession. The unemployment rate's been kind of flat, but incomes have been going down. So, that's just a brutal combination. There's not a lot of confidence that people want to do. Certainly not.
And I think a lot of people would argue, too, that even those numbers on the employment numbers are probably lower than what's real out there. A lot of people have just given up. They've dropped off the unemployment rolls. They're still not employed, but they're either underemployed or they're doing something on the side, but they're no longer in the official headcount for employment. So it's probably actually a little higher than the numbers reflect.
Yeah, I think too is if 60% of the economy is consumer driven, so to speak, and people don't have the money to spend, they're not going to be buying. And you've got all the corporations that have all this cash on the balance sheet that everybody's saying, well, let's just wait, so they're going to invest it and provide productive facilities. They're not going to invest because they don't see the orders. So this is one thing. This Fareed Zakaria or whatever his commentator said that economy can't be based on buying massages and mortgages, which is what we have. It's like we got to have something that people are really buying, and it's going to be difficult. We're coming out with our capital market assumptions for the coming year, and we're going to be continuing to lower them as we had the last year. So it's no time, I think, to be the conservative approach that you've taken. I think continues to make sense as we go forward, but it's not going to be as. Hopefully, things will improve in here, but it's not a happy time. What do you see too? Even coming in and seeing Jackson had, I guess, protests, Wall occupied Jackson or whatever. There was like 20 kids or something on the corner. But I mean, these things around the country, I think it's going to be interesting to see how those things grow, if they do grow at all. And it's an interesting, but it just shows the frustration that a lot of people out there have. It'll be interesting to see how that impacts going forward. Probably minor here, but
Okay, so we flip to page 3. Now we'll look at the gory details for the investment returns for